Australia's property market is charging into 2026 with prices still on the rise, even as interest rate uncertainty hangs over buyers.
In a bid to free up unused properties for renters, land tax on some homes in Victoria will triple as the state government strikes a deal with the Greens to pass the legislation.
The new normal in Perth. Around 30 people lining up to see this one-by-one apartment in Rivervale advertised at $550 per week.
Here's what most Australians don't realise. We no longer have one property market. We have two completely different countries operating within the same continent. In January 2026, Perth property prices surged 1.9% in a single month, while Melbourne dropped 0.6% in that same period. That's a 2.5% divergence in just 30 days. And this isn't a blip. Over the past year, Perth has rocketed up 17.2%, while Melbourne has crawled along at just 4.5%. That's a 12.7% performance gap, the largest divergence between two Australian capitals in modern history. Typically, capital cities move in a correlated wave, rising and falling together in response to the Reserve Bank's cash rate. That pattern is broken. What we're seeing now is what economists are calling the Great Divergence.
I mean, a simple answer to what is a really difficult question is supply, supply, supply. We do not have enough houses to put people in, and the numbers are showing it. So when you take a look at what this data from Quartality this morning, whether you're looking at houses or units, take a look at houses here. Have a look at Perth. In 1 month, it went up $23,000.
In this video, I'm breaking down exactly why Perth is experiencing a housing mania while Melbourne is stuck in a policy-induced correction, who's winning and who's losing in each market, and what the experts are predicting for 2026 and beyond. Let's get into it. Right? To understand what's happening in Perth, you need to see the footage that went viral across Australia. I've covered this before, but let me give you the full picture because it captures everything about this market. In August 2025, a prospective tenant named Lexi Sargent filmed something that shocked the nation. She was attending a rental inspection for a modest 3-bedroom villa in Osborne Park, a middle-ring Perth suburb that used to be known for its industrial character and affordable rents. What she captured was a queue, a snake of people, winding down an entire suburban street. Families, young professionals, retirees, all standing in line for one property. The listing agent confirmed that 92 groups had registered for that single inspection. The video amassed over 3 million views and became a symbol of the housing shortage. The property was listed for $650 per week. In a previous cycle, Osborne Park would have been an affordable option for working-class families. Now it commands premium rents with mass competition. As Lexi put it, quoting a woman behind her in line, "If you don't laugh, you'll cry." And mate, that perfectly captures the fatalism of the Perth renter class right now. And here's the thing that should terrify anyone trying to rent in Perth. Property managers are saying, this is normal now. Jules Blackwell said in a media interview that these events are now routine. Her exact words, "It wasn't even that unusual anymore. For the medium properties, I would say I don't see it dying down anytime soon." Another agent, Lynn Kelly, reported 140 people queuing in Bentley for a $400 per week unit and said she had never seen anything like it in 20 years of real estate. Think about what happens when 92 people compete for one rental and 91 get rejected. Those 91 don't disappear. They compound into the next inspection, creating what I call a rolling wave of desperation.
About 50 to 80 people in line just to inspect the property.
The new normal in Perth. Around 30 people lining up to see this one-by-one apartment in Rivervale advertised at $550 per week.
Landlords can effectively name their price because the sheer volume of applicants breaks through any rental bidding restrictions. Even if you offer exactly the asking rent, you're competing with 91 other families doing the same thing. So what do the numbers actually look like? Perth's vacancy rate sits at just 0.7%. That's effectively zero vacancy, just friction from normal turnover. To put that in perspective, anything below 2% is considered a rental emergency. Perth is operating at 1/3 of the crisis threshold. Compare that to Melbourne at 2.0%, which is considered balanced. But here's where the comparison gets absolutely cooked. Perth has just 1,384 rental listings across the entire metropolitan area. Melbourne has 10,667. That's nearly 8 times the stock available. Properties in Perth are selling in an average of 9 days, the fastest in the nation.
Spring selling season has seen a surge in auctions, and some first-time buyers feel they're being priced out.
We've been to a few auctions now and there's so many people bidding and a lot of investors. So yeah, we know that there's a lot of competition.
The national average is around 27 days. Melbourne properties sit on the market for over 30 days. And Perth's listings are sitting at 45% below the 5-year average. There's simply nothing to buy. When you factor in yields, the arbitrage becomes obvious and explains why investors are flooding into Perth while fleeing Victoria. Perth investors can achieve gross yields of 4.5% to 5.0% in high-growth corridors, with rents rising 13% to 15% annually. Melbourne rents are rising just 2.9%, and when you factor in the new land tax, the net yield for many investors turns negative. Total returns in Perth are running at around 22% when you combine capital growth and rental yield. Melbourne investors are lucky to see 3 to 4% after costs and taxes. The maths doesn't maths for Victorian investors anymore. Now let me paint you a picture of what this divergence actually means for regular Australians trying to get into the market.
There's already so much pressure at the low end of the market. First home buyers are going to be getting less bang for their buck because of that additional acceleration in price.
There's more competition for those homes in those affordable suburbs. And the irony there, of course, is that the strongest price growth we're seeing in the country is typically in those more affordable areas.
PropTrack analysis suggests that Perth's $1 million club is expanding rapidly. Their exact prediction: if Perth property prices increase as expected over 2026, we could easily see the $1 million club reach 150 suburbs by the end of the year. Translation: suburbs that were historically working class are gentrifying overnight. The ripple effect is forcing buyers further into the outer rings like Armadale and Baldivis, pushing the price shock onto the most vulnerable demographics. First home buyers who thought they could afford Perth are being locked out suburb by suburb, just like I've been documenting for months. And it's not just Metro Perth feeling the heat. Regional Western Australia recorded annual growth of 13.5%. As the metro area becomes unaffordable or simply unavailable, the fly-in fly-out workforce and lifestyle buyers are pushing into Bunbury, Busselton and Mandurah. These markets are effectively functioning as distant suburbs of Perth now due to improved transport links. While Perth is experiencing a supply-driven mania, Melbourne is suffering from something entirely different: a policy-driven correction that's accelerating the exodus I've been tracking for months. The singular most impactful variable is the Allen government's State Taxation Further Amendment Act 2025. This legislation has fundamentally altered the investment equation in Victoria.
Her failed pick for Deputy Premier and reappointed Treasurer was in the firing line after Tim Pallas told property industry leaders that more vacant land would be taxed.
Let me break down what this legislation actually does, because it's created what analysts are calling a pincer movement on property owners. First, the land tax-free threshold was slashed from $300,000 to just $50,000. This is massive. Previously, mum and dad investors owning a single apartment or modest house were exempt from land tax entirely. Now, almost every investment property in the state is captured, including modest units and regional blocks that were previously exempt. Second, there's a fixed surcharge of $975 plus increased rates. This acts as a regressive tax that hits smaller investors hardest by eroding a significant percentage of rental yield on lower value assets. Third, the vacant residential land tax was expanded to cover the entire state at 1% of the capital improved value. Holiday homes and land banking are now targeted, but the policy relies on self-reporting and complex exemptions, creating uncertainty for owners.
Biggest changes in my view for land tax here in Victoria. So as you'll see in that first point there, it used to just be in 16 inner and middle suburbs here in Victoria, but as of this year that has increased to the whole of Victoria.
Well, most people just thought it was a tax grab by the government and were very frustrated and if not furious.
And fourth, the congestion levy in Category 1 areas rose to $3,030 per parking space, increasing holding costs for commercial properties that often underpin mixed-use developments. Now let me show you what this actually looks like for real Victorians, because the abstract policy talk means nothing without the human stories. Meet Emily and David Gridley. They own a block of land in Moe, regional Victoria, which they purchased for $440,000. They received a land tax bill of $32,000. Let that sink in. $32,000 on a property they paid $440,000 for. The bill was based on a revaluation by the Valuer General, who took over from local councils, that pegged the property's value at over $2 million. The Gridleys disputed this, citing a lack of power and water infrastructure on the land. How can unserviced land be worth $2 million? This wasn't even their first fight. They had previously contested a $20,000 bill based on a $1.6 million valuation, which was successfully reduced to $770,000. The Gridley case illustrates the aggressiveness of revenue collection.
There's no power, there's no water, there's only access through the easement that's there. It's basically a battle axe block.
At the moment, it's probably worth more money for hay than anything.
What you see is what you get. There's no rhyme or reason or quantification as to what's going on. So it's like they're saying it's going up, but the reality is that it's nowhere near that. A block has risen in value twice in 2 years by 100%. It just doesn't make any sense.
By shifting valuation authority to the Valuer General, the state has systematically increased the tax base. For any investor watching this, the risk of a massive, seemingly arbitrary tax bill makes holding property in Victoria genuinely untenable. The sovereign risk is real. The rules can change and capture your capital without warning. The market data confirms the investor exodus I've been documenting. CoreLogic reports a 15.5% year-on-year increase in new listings in Melbourne for December. In a falling market, rising listings usually indicate distress or forced selling. Investors aren't selling to take profits because prices are down. They're selling to stop the bleeding from negative cash flow made worse by land tax. Melbourne values fell 0.6% in January 2026, and the city remains 3.9% below its previous peak from March 2022. While other cities have recovered and surged past their peaks, Melbourne is stuck in a deflationary trap. And here's where it gets worse. This investor exodus isn't just about listings. I've covered this extensively. Melbourne has lost over 20,000 rental properties as landlords dump their holdings.
Property investors are fleeing Victoria, leaving fewer rentals on the market. They blame land tax, but the government says that's not the case.
It becomes very untenable to hold the properties when you're held in such disregard.
Recently released data suggests investors like Michael are selling up. Victoria's tenancy bonds dropped by more than 10,000 since new hikes took effect at the start of the year.
Meanwhile, over 100,000 families have fled Victoria for Queensland, taking their wealth and their purchasing power with them. ABS data confirms net interstate migration losses for Victoria and gains for both Western Australia and Queensland. A family selling a median Melbourne home at around $772,000 can buy a superior asset in Perth for $750,000 to $900,000 with lower transaction costs, no land tax on the family home, and better growth prospects. This arbitrage is fueling the middle to upper bracket of both Perth and Brisbane markets. Melbourne's pain is directly funding Perth's boom. So why can't Perth builders simply build more homes to meet this insane demand? The answer is a complete failure of supply response. Despite the price signal that should theoretically trigger a building boom, new supply is strangled. Construction costs in Western Australia have risen 37% since pre-COVID levels. The mining sector competes for the same trades: electricians, welders, heavy machinery operators. With commodity prices strong, the mines pay premiums that residential builders simply cannot match. A Sparky can earn far more working on a mine site than wiring houses in the suburbs. And the fixed-price contract model that decimated the builder sector in 2022 to 2024 has made surviving builders extremely cautious. They're increasing margins and refusing risky contracts. The profitless boom I've discussed before has created lasting trauma in the industry. The WA government is attempting to address this with a $50 million Housing Innovation Fund, offering grants of up to $5 million for alternative production methods like modular, prefabricated, or automated building technologies. The stated objective is to enhance the productivity of housing delivery across the supply chain. But here's my honest take. $50 million is a drop in the ocean for a market requiring tens of thousands of homes. It's sound long-term industrial policy, not a short-term supply fix. It won't deliver keys to tenants in 2026, and even when the government announces land releases like the East Wanneroo project covering 8,000 hectares, there's a massive gap between announcement and delivery. Unlocking land through zoning is not the same as developing land with sewerage, power, roads, and titles. The lead time from announcement to turnkey is 3 to 5 years. REWA CEO Kath Hart notes that delays in the building industry force tenants who are building their own homes to stay in rentals longer, which clogs the rental funnel and makes the vacancy crisis even worse. What we're really witnessing is a tale of two political philosophies playing out in real time. The Cook government in Western Australia, flushed with mining royalties, is pursuing a growth and supply narrative. Their rhetoric focuses on infrastructure pipelines worth $38 billion and delivering election commitments. While they've introduced rent bidding bans and limited the frequency of rent increases, they've steadfastly refused to implement rent caps or freeze evictions, wary of spooking the investors they desperately need to build supply. They're positioning WA as the engine room of the nation, using budget surplus to subsidise industry rather than tax it. The Allen government in Victoria, constrained by massive COVID debt, is pursuing redistribution and repair. In question time, when challenged on the new taxes, Premier Allen stated, "Of course this has gone through Cabinet."
Was the Premier aware the Treasurer was going to announce these new taxes this morning?
Of course I was aware, because this has gone through Cabinet, Speaker.
The government frames these measures as necessary for debt repayment under the COVID debt repayment plan and for housing supply by forcing vacant homes onto the market. The opposition argues Victoria is broke and that these taxes target aspirational Australians. The market interpretation is clear. Victoria now carries a sovereign risk premium. Rules can change retrospectively to capture capital. This creates an adversarial relationship between the state and investors. The policy achieves its goal of revenue raising in the short term, but destroys the tax base in the long term as investors leave. It's a doom loop that's already playing out. So what happens next? The trajectory for 2026 depends heavily on the Reserve Bank, and this creates two very different scenarios for both markets. PropTrack has warned a rate rise at the Reserve Bank's February meeting is now looking likely, with inflation coming in stronger than expected. If rates rise, the impact on Melbourne would be catastrophic. Investors already bleeding from land tax would face higher mortgage costs, likely triggering a wave of fire sales that could push prices down another 5% to 10%. The suburbs already crashing that I've documented would fall further. Perth would be dampened but not destroyed because the cash-heavy nature of buyers from interstate migrants and mining money provides insulation against rate movements. If rates are cut later in the year, as CoreLogic and AMP expect, Perth could experience what analysts call a melt-up. SQM research predicts growth of 14% to 19% in a rate cut scenario. Lower rates would supercharge borrowing capacity for buyers already desperate to get in. Melbourne would likely stabilise but not boom, as the tax regime remains regardless of rates. Tim Lawless from CoreLogic describes the national market as a tapestry of performance, with regional markets and mid-sized capitals like Perth, Adelaide and Brisbane continuing to outperform due to the affordability advantage. Louis Christopher from SQM Research is the most aggressive forecaster. He's bullish on Perth and bearish on Melbourne. His forecast of up to 19% growth for Perth is predicated on the supply shortage being unsolvable in the medium term. If he's right, Perth's median could approach $1.1 million by year's end. For Melbourne, the long-tail risk is structural stagnation. Even if rates fall, the tax regime remains. Unless the State Taxation Further Amendment Act is repealed, which is unlikely under the current government, Victoria may face what some analysts are calling a lost decade of property growth similar to the 1990s. Here's the truth. The Australian property market, as a singular concept, is effectively dead. In 2026, we're witnessing the emergence of two distinct economic realities within one continent. Perth is a frontier boomtown defined by scarcity, wealth generation, and manic competition. It's a market where 92 people queue for a home because the economy is growing faster than infrastructure can support. It's a humanitarian crisis of success, brilliant for existing owners, devastating for those trying to get in. Melbourne is a post-growth economy in repair, defined by taxation, liquidation, and investor fatigue. It's a market where listings surge 15.5% because the cost of holding wealth has become punitive. Families are fleeing. Landlords are dumping properties. First home buyers face a different crisis. Affordability remains broken even as prices stagnate. For investors, renters, and homeowners, recognising this divergence is the only way to navigate 2026. Geography, now more than ever, is destiny. I'll be covering both markets every week, tracking the data, exposing what's really happening, and holding politicians accountable. Subscribe to Aussie Explained so you don't miss the next video. Thanks for watching. See you in the next one.